Welcome back. In this video, we're going to talk about the ups and downs of the stock market and investing for the long term. For you folks out there that are under 35 years of age, investing in the stock market for the long term is not a bad way to go. Historically, the stock market's paid a little over 8%. And what you have is a wave like this where the stock market goes up, goes down, goes up, goes down over long periods of time. The key is to time the stock market for when you want to get out and when you're going to retire. And that then is really the problem. You see, if you're 75 right now and you've been in the stock market all this time and the stock market came down like this and now you've got to sell your stock to live, well, that's not really good timing, is it? But if you're 35, you know that historically a stock market's going to go back up like that. And just maybe, if you're lucky, when you're 70, the stock market will be at that peak and you'll be able to sell all your stock, make that big profit, and get out of it and do something else with your money so that you can live the lifestyle you want to live when you're older. Because that's the point of investing long term, is to prepare for the future. So the biggest challenge with the stock market is because it is cyclical, and no matter who's president of the United States, no matter what the Congress is in, they can make it a little better or a little worse. But the truth is, the stock market's going to go up, the stock market's going to go down. And we can't time the stock market. So if you're in it for the long term, you have to really pay attention. And when the stock market starts reaching a peak, if you're starting to be 65, then maybe you need to take a look at getting out of the stock market because it's too volatile for you. If you're young, then an 8% return over 30 years is average at best, but it is a positive return. You have to balance that with inflation because inflation eats away at whatever profit. So if you have inflation at 3% a year and you have an average 8% return, you really had 5% on your money for 30 years, which I guess is better than stuffing it in a mattress. So anyway, just understand that the stock market works like that, and there are other investments out there that you can take and put some of your money in, and most people take their investment portfolio, and if you've got $1, you'll put 30 cents in something real risky, 30 cents in something real safe, and then you'll put 40 cents in something that's kind of average. And then depending on where you are, how old you are, you might change those percentages a little. But you want to look around at all the options out there, whether it's gold, whether it's the stock market, whether it's bonds. There are other investments out there that we're going to talk about later on in the series that return really high rates of return, but a lot of them are restricted by the SEC, that's the Security Exchange Commission, to rich people only. Robert Kiyosaki is absolutely correct in his book on investing when he talks about his rich dad telling him that there are investments only for rich people and that poor people can't play. Now, why is that? I don't know. Maybe it's because rich people make the rules. In any event, there are investments out there that are returning 15% or more safely. However, if you're not a certified accredited investor, keyword accredited, you can Google accredited investor and find out what the rules are for that. And if you don't fit that standard, then you can't play. So people like the Donald can go out there and they can slap a couple of $1,000,000 in an investment that's safely returning 15%. And if all you have is $50,000, you're stuck with 2 and 3%. Kind of sucks, actually. But that's the way the rules are because the government, the Securities and Exchange Commission, wants to protect us poor, dumb people from investing in something where we might lose our money. Or as I feel, we might actually make the same profit as the wealthy people do. So they put some rules in place to keep the non-wealthy non-wealthy and to help the wealthy become more wealthy. Have we heard that before? The rich get richer and the poor get poorer? Maybe we have. Anyway, I hope this video helps. In the next video, we're going to move on down the line and we're going to talk a little bit more about investment strategies and where you are in the cycle.